Hello everyone, I'm Pérez de Acha, the presenter of this webinar. Inteli-Iuris is a platform designed to democratize the knowledge of the law. One of the founding purposes of its partners and allies is to do it for free, as is the case today. Tax matters require the constant study of the changes that are implemented at the international level and that are reflected in different countries. After years of negotiations, the OECD announced on October 8th this year that 136 countries officially agreed on certain key parameters to reallocate some taxing rights to market jurisdictions, known as Pillar I, and introduce a global minimum effective taxation, known as Pillar II. Pillar I will ensure a fairer distribution of profits and taxing rights among countries regarding the largest and most profitable multinational enterprises, the so-called pay where you play. Pillar II introduces a global minimum corporate tax rate set at 15%, which does not seek to eliminate tax competition but to put limitations on it. The international agreement is not automatically applicable. It first needs to be implemented by the signatories. Technical details will be released over the next months, starting with Pillar II rules published last November. Pillar I rules will be detailed over next year. The entry into force will be progressive as from 2023. Talking to experts around the world is essential for us to know the contents and scope of both pillars of the global tax deal. We no doubt our speakers will facilitate the understanding with a perspective vision of the implications and challenges that the modifications agreed by all the countries will have in the future. On behalf of Inteli-Iuris, I'd like to thank Valentyn Kolosov for organizing this webinar and inviting today's top-notch lecturers. Valentyn is a highly qualified and experienced tax advisor specialized in international tax structuring and planning. He holds an LLM in international tax law from King's College London. Valentyn also obtained the advanced diploma in international taxation from the Chartered Institute of Taxation. Additionally, he holds the advanced professional certificate in international taxation from the International Bureau of Fiscal Documentation. He's a member of the International Fiscal Association and has been published in the Bulletin for International Taxation. I cannot close this presentation without thanking Amanda and Vikram for their participation in this panel and their open willingness to share their tax knowledge and expertise. Valentyn, please take it away.
Thank you, Luis Manuel, for your kind presentation. Good morning or good afternoon, everyone, depending on where you're joining us from, and welcome to the webinar. Today we're very honored to have exceptional panelists to talk about historical, without exaggeration, changes that are happening in the international tax field. We have today two speakers. It's Amanda and Vikram. Amanda is a partner in the Washington, D.C. office of Steptoe Johnson LLP. She advises multinational businesses, family offices, and high net worth individuals on U.S. federal income tax matters with particular focus on international tax planning and controversies. Amanda is also a professor of law in the graduate tax program at the Georgetown University Law Center, where she teaches U.S. international inbound tax. Vikram is a professor, doctor, an independent specialist in international tax law and policy-related matters. His core areas of expertise relate to transfer pricing law and policy, tax treaty law and policy, digitalization and taxation, Pillar I and Pillar II rules, as well as the tax relations between EU and third states. Vikram is also the program director of the executive program in transfer pricing offered by the University of Lausanne, Switzerland. Vikram has been appointed by the OECD as an international tax training expert and has trained tax officials from several countries, in particular on transfer pricing and BEPS-related matters. He's also regularly involved in public consultations organized by the OECD. Vikram is the managing editor also of the Kluwer International Tax Law blog that already everyone knows. The blog has 5-figure readers on a monthly basis. He has been approached by MNEs, tax administrations, local governments, and consulting firms on a regular basis to provide advice and litigation support, pre-dispute and post-dispute phases on key areas of expertise. In a moment we will start the discussion, but first let's look through logistic matters of today's webinar. The purpose of the webinar is to discuss potential impacts of the global tax deal, as well as challenges and uncertainties brought by the new rules. We have divided the webinar into 3 parts. In the first part, our experts will give us an overview of the global tax deal and outline what it means for multinationals. Then in the second part, we will focus on pitfalls and challenges of the global tax deal. I will ask several questions to our panelists to get their insight on each of the pillars. And finally, in the last part, we will talk about regional perspectives. Our experts will share their observations and insights on next steps and what is happening in the European Union and the United States. So as you can see, we have a very ambitious agenda to cover. So if you have any questions, please kindly wait until the end of the webinar to ask them. We'll have a Q&A session to address as many questions as the time allows us. And finally, the webinar is being recorded and we will share a link after the session. So with this brief introduction, let's get started with the first part. Well, as you know, digital transformation and globalization of the economy have challenged in many ways the proper functioning of the international tax system. The global tax deal agreed last July and updated in October aims at addressing 2 key challenges. The first one is that multinationals employ business models that allow them to generate business profits in market jurisdictions where the customers are in an active and sustained manner without creating any physical presence or having a very limited one. As a result, based on traditional profit allocation rules, very little profits or no are allocated to market jurisdictions where some value is also created remotely and therefore should be recognized and taxed accordingly. The second challenge is that multinationals structure their operations through jurisdictions that impose very little or no tax, which in principle would not pose a problem if the choice of jurisdiction is based on sound commercial factors and genuine business activities are carried out there. This was actually the main message and the main objective of the BEPS project, to ensure that business profits are taxed where the economic activities take place and value is created. So the purpose of the global tax deal is to resolve this problem so that multinationals pay a fair share of tax wherever they operate or headquartered. And to make it happen, complex and very complicated and coordinated actions with most of countries on board are required. And nowadays, these problems have assumed even greater importance due to the COVID crisis and increased public spending on healthcare and recovery of the economy. So in this context, I would like now to ask our experts to give us an overview of the global tax deal and how it is expected to address these problems. Amanda and Vikram, the floor is yours.
So Valentyn, I think I need to start, right, if I'm not mistaken. And I will just share my slides. Just give me a second. So thanks a lot, Valentyn, for introducing Amanda and me as well as the topics. I think you've done it in an excellent manner. But just to go get back to the basics and just to start right from scratch. The question which Pillar 1 is trying to address is how do you go about allocating more taxing rights and M&E profits to market countries? Because as we all know, with the rise of digitalization, a lot of multinationals, they are moving away from tangibles and they are really focusing on intangibles. At the same time, you have a lot of multinationals, especially the digital multinationals, who are leveraging on the data that they collect from users, and basically they sell this data and they make a lot of profits. And you have a lot of multinationals at the same time who can scale massively on the internet. And just to give you a few examples, one of them is Netflix. So what's happening with digitalization is that a lot of multinationals, they can centralize their businesses in one country, possibly in a low tax country, and they can operate on a remote basis without any physical presence in the market country. Now, if under the current international tax system, if there is no physical presence in the market country, then the market country is not permitted to tax the corporate profits of a multinational enterprise. So the entire issue which Pillar 1 is trying to address is how do you go about taxing global multinationals' profits in the market country. Now, what we have witnessed, by the way, this question is not something new. You have academics discussing this question since the 1990s, especially the US academics. So this is not really something new question that has been raised, but this question has come to the limelight because of the way public sees multinationals. And the fact is that as a result of the BEPS project, this was one of the unfinished businesses of the BEPS project. So in order to finish it, they had to come up with something. So what we are seeing right now is, before I get into the Pillar 1 project, which Valentyn you've already described, is that there's been a rise among countries of introducing digital service taxes, unilateral measures in the form of DSTs. So a lot of countries in the world, they have started introducing unilateral measures to tax mostly digital businesses. But these unilateral measures like digital services taxes raise many issues. Just to name a couple of them is that they lead to double taxation because, if you pay the tax in the market countries or the countries where the users are, then it may be creditable tax in the state of residence of the enterprise. That is one issue. Second issue is very important issue is that these taxes are gross-based taxes, and they are not really on the net profits. They're on gross income that has been derived by a multinational business. So this trend is being witnessed, and the US has actually reacted in a, let's say, in not such a favorable manner against countries who started introducing these digital service taxes. And there have been some trade tensions. And in order to diffuse these trade tensions, the OECDs, started speeding up the work on the Pillar 1 project. And they came up with this two-prong approach known as the unified approach, in which they introduced two amounts. So in the OECD's blueprint, there are two amounts that is mentioned. So you have amount A and amount B. Amount A basically is an add-on to the existing international tax system. Now, why do I say an add-on? Now, what does this mean? If you look into the current international tax system, each and every entity of a multinational enterprise, whether it's a separate legal entity or a branch, they're treated as a separate entity for tax purposes. So for example, if you have Netflix, which has a subsidiary, Procter & Gamble, which has a subsidiary in Mexico, this Mexican entity is treated as a separate legal entity, and they will file, on whatever profits it makes in Mexico, it will file a corporate income tax in return in Mexico, and basically it will be assessed on the profits it generates in Mexico. So each and every entity of a multinational group is treated as a separate entity. But what amount A is doing right now is that it is going beyond the separate entity approach, and it's moving towards, or it has moved towards, an M&E group approach. where the multinational groups consolidated results are taken into account in order to determine the profits that need to be reallocated to the market countries. So what we are going to see in the future is that we will have the existing separate entity system, and profits are allocated within the separate entity system based on transfer pricing rules. On top of this, you will have the new system, this Amount A system, which treats the entire multinational enterprise as one single economic unit for tax purposes. At the same time, there was an Amount B which was introduced, and this Amount B is an amount which stays within the existing transfer pricing separate entity system. What this basically means is that if you have, let's say, an American multinational, once again like Procter & Gamble, it is operating with a limited risk distributor in Mexico. In this kind of situation, what Amount B basically does is that it will say, okay, there's going to be an upfront fixed remuneration for the limited risk distributor, probably 3% of sales. And why an Amount B has been proposed is basically to reduce disputes between taxpayers and tax administrations on how much profit shall be allocated to distribution functions. So this is just a background. And let me just explain to you how the Amount A system works before and after. I will speak about Amount B a bit more later, but let me just explain to you how the Amount A system works. In this example, if we assume that we have a multinational which is in the business of selling streaming services, probably you all know which multinational it is, which has exceeded more than 20 billion of sales on streaming services. So let's say it is headquartered in the US, and for the US market, it basically sells in the US market to US customers through the US entity. So when for example, an American who's sitting in America has access to a Netflix account, Netflix will send them a bill on behalf of Netflix in the USA. So let's just assume that's the US market, but for outside the US market, let's just assume that the multinational has set up a principal kind of business model, a principal structure, a centralized business, which is operating out from the Netherlands. And this Dutch entity that we see here is basically selling the streaming services not only in the European market, let's just assume for simplicity's sake, for the rest of the world, outside the US. And all the income that is actually being booked in the Dutch entity is actually income that is coming from all these markets. So if you look into the existing international corporate tax system, these profits which are derived from Austria, Belgium, Italy, India, Mexico, Nigeria, for these online streaming services, they are taxed only in the Netherlands. They are not taxed in the market countries where you have all the customers who have access to these accounts, accounts of the online streamer. So what is the Pillar 1 project doing? Now, post Pillar 1, what's going to happen is that because of the Amount A system, profits will be determined using the consolidated financial statements, and then they will be reallocated to all these market countries. So after the Amount A system comes into force, all these profits of this digital company that I'm talking about will be allocated to market countries. And then the question that arises is, when the market countries tax these profits, like Austria, Belgium, or Italy in our example, if they start taxing these profits, which entity in the multinational group will provide relief from double taxation? Or in other words, which country is going to be the surrender jurisdiction? And the answer to that in this kind of business model setup is very simple. It will be the Dutch entity. So because the Dutch entity has a connection, a market connection with all these different markets, so the Dutch entity will be the entity that will be providing relief from double taxation. So that is how the Amount A system will actually work. And just a few words on the key design features. Now, with respect to Amount A, what you need to know is that this Amount A system is going to only apply to multinational groups whose gross revenue exceeds 20 billion euros. There is an exception for the financial services and as well as the extractive sector, but in general, the rules are going to be applicable to M&E groups which exceed 20 billion of sales. So the idea here is to start with the large M&Es and then try to reduce the turnover threshold to 10 billion, probably after 7 years. But let's see what happens after 7 years. Maybe the system is there, or maybe it collapses. We don't know. If the system collapses, then nothing is going to happen. It's just going to be a flop. But assuming that the system is successful, then after 7 years, it will apply to smaller M&Es. Then probably, if I just look into the crystal ball, after 14 years, it will be dropped down to 5 billion. Then 7 years after that, it will be dropped down to probably 1 billion. But it was important to start with the 20 billion revenue threshold in order to just test the system. What you all need to know is that these rules would apply to multinational groups who have more than 10% operating profit by sales based on their consolidated financial statements. So if you typically take all the big digital multinationals like Facebook, Google, or Netflix, they will easily meet this threshold because they are operating at more than 10% operating margin based on their consolidated financial statements. When it comes to the profit determination here, like I told you, the entire multinational group is treated as a single economic unit, and the profits of this multinational group are not going to be determined by taxable accounts or financial accounts of each and every separate entity. They're going to be determined on the basis of consolidated financial statements. And for most of these multinationals who have more than 20 billion euros of sales, you find their consolidated financial statements in the investor relations section of their website. So, for most of these multinationals, the information is available. Once you determine the profits that need to be reallocated, or profits which are up for reallocation, then the reallocation exercise will take place. And only what you need to know is that 25% of the residual profit will be reallocated to the market countries. So if you take a digital multinational who's operating on a 30% operating margin, and if you say that 10% is the routine profit, so 20% is going to be the residual profit, and 25% of this 20%, which is basically 4% or 5%, is what is going to be up for reallocation to the market countries. And the reallocation will take place in the market country only if a nexus threshold is surpassed. Now, for developed countries, the nexus threshold is determined at 1 million. So you need to have 1 million of sales in order to ensure in that particular market, in order that market gets an allocation of the profits. And in some developing countries, it's around 250K. So if you take some small African countries, that is more relevant for them, the 250K threshold. One of the sticking points of the proposal right now, which we will come back to a bit later, is to determine which country or which entities in the group will provide relief from double taxation. In my example that I gave before, it was very easy. It was the Netherlands, but multinationals' business models actually vary from, the business models which multinationals adopt vary from multinational to multinational. So a very strong, so if you really want to excel in this amount A system, you would really need to understand the different business models of multinationals, how transfer pricing rules work, how profit allocation works under the current system, in order to really determine which entities within the group need to provide relief from double taxation. Now, there's going to be a big, this entire proposal comes with a big dispute prevention mechanism, because of course there are going to be disputes. But there's a big dispute prevention mechanism that is being built up. But at the same time, there's also a dispute resolution mechanism that is going to be built up for in-scope taxpayers. And this dispute resolution mechanism is not only applicable for the amount A tax liability, but it is also applicable to existing transfer pricing disputes, whether they relate to Article 9 or Article 7, which deals with permanent establishments. So like an in-scope taxpayer, for example, Netflix or Nestle or Procter & Gamble, they will also have access to binding dispute resolution mechanisms under the existing system too, at least in some countries, whereas for some other countries, it's going to be based on a binding kind of approach. With that, I hand over the floor back to you, Valentyn.
Sorry. Thank you, Vikram, for such an insightful outline. Please, Amanda, could you please help us with an overview of Pillar 2? Thank you.
Sure. I would be glad to present on Pillar 2, and thank you very much for the opportunity to present today and also to share the floor with Vikram. And that was an excellent presentation on Pillar 1, so thank you very much. And I will also go ahead and share my screen for some slides. Okay. So as Valentyn mentioned earlier, what is the problem that Pillar 2 is trying to address? So at a high level, Pillar 2 is intending to address a concern that under our existing international tax rules, there's an incentive for multinational corporations to shift profits to no or low tax jurisdictions. And that related to that, countries have an incentive to lower their tax rates to attract foreign investment in what one might call a race to the bottom. So one of the central reasons that income shifting might occur is illustrated on the diagram here, and we'll talk about that, which is many countries have rules under which income earned in other jurisdictions are exempt from tax. So in this example we have here on the slide, we have a parent corporation, and we'll assume that's in a high tax country. It has two subsidiaries, one foreign subsidiary, one in a high tax country and the other in a low tax country. If the parent jurisdiction has a regime under which it doesn't tax profits of the low tax subsidiary, either when those profits are earned or when they're distributed back up to the parent, then there may be an incentive for the other group companies to move profits over to the low tax foreign subsidiary, such as through deductible payments or in some cases a shift of activities. In the United States, where I'm from, we have a different system that was most recently modified in significant form in 2017 called the Global Intangible Low Taxed Income or GILTI regime. And under our regime, the U.S. would tax profits of the low tax subsidiary here, albeit at a lower rate than the U.S. would apply to U.S. income earned by the parent corporation. And we'll talk a little bit more about the GILTI system later and how it compares to what the OECD has proposed with Pillar 2. So at a high level, the goal of Pillar 2 is to make sure that the largest multinational enterprises are subject to a minimum tax rate of 15%. And the way that Pillar 2 would do this is through three different mechanisms, which together are called the Global Anti-Base Erosion or GLOBE system. The first two mechanisms proposed are contemplated to be rules that countries would adopt in their domestic laws. And the third rule is one that is intended to be implemented through tax treaties. And these three rules, which I'll go through in more detail, are called the Income Inclusion Rule, the Undertaxed Payment Rule, and the Subject to Tax Rule. And the threshold for applying these rules would generally be 750 million euro in gross revenue. And some entities, specifically investment and pension funds, government entities, and nonprofits would be excluded from the rules. So I'll turn now to describing the rules. And before I get into them, note that I'm going to be describing things at a very high level, there are many technical questions still need to be worked out and finalized, and I'll be focused more on the basic operation of the rules rather than some of the more detailed aspects, although I may raise some questions about those. So turning to the first rule, the Income Inclusion Rule, or IIR, the basic idea behind this rule is that an ultimate parent company will impose what's called a top-up tax if the income of a controlled subsidiary is taxed at a rate less than 15%. So basically, the ultimate parent will take taxing jurisdiction over income that isn't subject to the 15% tax rate elsewhere. If the ultimate parent doesn't enact the income inclusion rule in its domestic law, then it's contemplated that taxing rights would then be passed down in the ownership chain. So on this slide, to take a very high-level example of how this would work, we have the basic structure we've been looking at. Here, we have ultimate parent corporation in country X, and we'll assume for purposes of this illustration that the ultimate parent has adopted the income inclusion rule, and it has two subsidiaries, one in country Y, and we'll say there's a 20% rate, and the other subsidiary in country Z, which doesn't impose an income tax. So what the income inclusion rule would require is that we calculate the effective tax rate, or ETR, on a jurisdiction by jurisdiction basis. So the ETR will be calculated as a fraction that's equal to covered taxes over income as determined under the globe. Covered taxes are the taxes imposed on an entity's income or profits. And then the income, so the denominator in our fraction, is going to be a specified tax base that is contemplated to start with financial accounting income and then make some adjustments, which the OECD has said would be consistent with the tax policy objectives of Pillar II and mechanisms to address timing differences. So with that, one major question for business is going to be the complexity of this regime, including, but certainly not limited to, how the financial accounting income is going to be used and broken down into different jurisdictions. And then on top of that, what adjustments are going to be made. And will also be a question about how much businesses will be able to rely on existing data, such as that already exists for accounting and tax purposes, or whether new data will need to be gathered or systems will need to be developed to track existing data. So if we take a very simple example, our example here, let's assume that we have this structure and country X enacts the income inclusion rule. And we'll assume that foreign subsidiary 2 in country Z, that's a no tax jurisdiction, has $100 million of income and pays no taxes. So its ETR in this case is 0. Then what the income inclusion rule would basically allow is now country X, as the ultimate parent jurisdiction, would impose a tax so that foreign subsidiary profits are taxed at a 15% rate. So going back to what we talked about is trying to be achieved here, the overarching policy goal here is to create a disincentive for businesses to shift profits to a no tax or a low tax jurisdiction. So in our example here, country Z, because under this new system, under the IIR, those low tax profits are going to be taxed at the parent jurisdiction at a 15% rate. And then related to this goal, there's also the related goal of creating an incentive for country Z to consider enacting its own 15% rate. And this, of course, raises many questions for low and no tax jurisdictions that may offer lower taxes, lower tax rates to attract foreign investments. So that is the first proposed set of rules. Before I turn to the next one, just also want to note that there would be carve-outs from income that's taxed under these rules. One major carve-out being what's called a substance-based carve-out. And what this would basically be would be a percentage of payroll costs and tangible assets. And the carve-out is contemplated to be larger at first and then decline over a series of years. So as proposed, the carve-out in the first year of effectiveness is contemplated to be 8% of the what's called the carrying value of tangible assets and 10% of payroll. And then it's also contemplated that those percentages would decline over time, over a period of years, and would subsequently, at the end of that period, be 5% of both tangible assets and payroll. There would also be rules for loss carryovers, which would be important to provide a smoothing effect over years, but will also raise a number of technical implementation questions that will need to be addressed. So we'll turn now to the second rule in the Pillar 2 proposals, which is called the Undertaxed Payment Rule. And what this rule is it's essentially a backstop for the first rule, the income inclusion rule. And one of its purposes, a major purpose, is to create a disincentive for companies to be headquartered in low tax jurisdictions that don't enact an income inclusion rule, the first set of rules that we talked about. The precise mechanisms are complex, but the basics can be illustrated through a simple example that we'll go through. So if we take the basic structure that we've been working with, but now instead of assuming that our parent is in a high tax jurisdiction and has enacted the IIR, let's assume now that the parent is in a no tax jurisdiction and doesn't have an income inclusion rule. Parent has a subsidiary, which is foreign subsidiary 1 here in country Y, which we'll say is a 20% jurisdiction. And that parent makes a deductible payment to another low tax subsidiary. So in this case, what the undertaxed payment rule would essentially do is have country Y, in which foreign subsidiary 1 is resident, either deny the deduction for the payment that's made to country Z, where foreign subsidiary 2 is, or essentially allocate a portion of a top-up tax to country Y and allow it to tax that amount. And that, again, is under a rather complex mechanism that we won't get into detail in now. So those are the first 2 rules contemplated by the Pillar 2 globe. The third rule is called the subject to tax rule, and that is contemplated to be enacted through tax treaties. And what this rule would essentially do is allow source jurisdictions to impose limited source taxation on certain related party payments that are taxed below a certain rate. And the covered payments here would be interest, royalties, rent, franchise fees, insurance or reinsurance premiums, and other payments that are specified. And the rule at a high level would kick in where a payment is made from one country and the recipient of that payment, the tax on that payment is less than the minimum 9% rate. And again, this would apply in a connected party situation, so where these are related parties. And in this case, the payor jurisdiction would then essentially be allowed to impose a tax with respect to that payment that's equal to the difference of the rate that's actually applied to the payment and the 9% rate. So that is my summary of Pillar 2. So again, this new set of rules called the GLOBE rules, and three rules: the income inclusion rule, the undertaxed payment rule, and the subject to tax rule. So with that, I will turn it back over to Valentyn to continue.
Many thanks, Amanda. Very interesting. Thank you very much. As we can see, the new rules are very complex and will apply in addition to traditional profit allocation rules. And therefore, the key challenge would be to make them work seamlessly in already sophisticated existing tax system. Otherwise, the new rules could potentially lead to double or even multiple taxation. And this is where the technical work hopefully will continue next year. As we can see, the scope of the new profit allocation rules is not subject anymore to specific activities. So it seems that Amount A could potentially apply to any company, especially in the long run, and not just digital companies or several other types of businesses initially targeted by the OECD policy objectives. As our experts commented, Amount A and the global minimum tax will apply only to large companies that meet the respective thresholds. However, it seems that there are a couple of rules within the global tax deal that are sort of standalone rules with their proper objectives and will apply to any company regardless of its profitability or global turnover. It's Amount B and the treaty-based subject to tax rule. So the bottom line is that multinationals will have to review and put in place where required the proper controls and internal policies to be compliant with new tax obligations. From now on, it seems that pillars considerations will be an important part of tax structuring analysis. Now let's move to the second part of the webinar, and here we'll take a more practical approach and we'll talk about impacts of the global tax deal. We'll discuss how the new rules will affect multinationals and what challenges in the process they should be aware of. Of course, we need to be mindful that there is still a high degree of uncertainty with respect to technical details of the new rules. And we'll start with Pillar 1. So the new profit allocation rules are based on the idea that multinationals create value remotely in market jurisdictions, which is on its own quite a complicated topic to discuss. And therefore, some profit should be also attributable and taxed there. But since the current profit allocation rules based on arm's length principle, it's not capable of allocating any profits to such value because it heavily relies on functions performed, assets used, and risks assumed in the market jurisdictions. It's when Amount A comes into play to fill in this gap. So I understand that the fraction of profits Amount A that is intended to be allocated to market jurisdictions is, it represents a reasonable proxy for the relative value created in the market jurisdictions, and it is supposed to ensure that it doesn't capture also the routine profits allocated under the traditional profit allocation rules, transfer pricing. So in other words, it seems that Amount A will carve out the value drivers used by the traditional profit allocation system. However, it seems that, it is what it is. Amount A, conceptually speaking, is reallocation of profits already earned by other group entities. So it seems that there is this inevitable that there could be some interaction between the old rules and the new rules. So Vikram, how do you think the new rules will interact with the existing transfer pricing and profit allocation rules?
Well, thank you, Valentyn, for that question. And this is where before I start, I would just like to tell Amanda, in your presentation was really nice, and you've put across the most complicated, I think, among Pillar 1 and Pillar 2. Pillar 2 is much more complicated than Pillar 1. Pillar 1 has its complexities, but Pillar 2 is much more complicated, and I think you explained the rules in a very easy manner, and that's really appreciated too. Coming back to the Pillar 1 debate, so how do these Pillar 1 rules actually interact with transfer pricing rules, and what could be the challenges going forward? And I would just like to illustrate this with a multinational, which is basically selling physical goods, because here I think the biggest issues arise in these kind of business models where multinationals are selling goods. So if you take companies like Procter & Gamble, Johnson & Johnson, Nestle, or even BMW and so on, these companies which will be in scope and which actually sell physical products, physical goods. So, just to give you an example, if you start with a simple example of before Pillar 1 and after Pillar 1, so we can just assume here we have a US parent, and the US parent has a principal structure operating out of Switzerland for the outside the US market, because like I mentioned to you, typically for US sales, that is typically done through a US entity, and it's booked locally. But for the outside the EU market, or outside the US market, I'm sorry, let's just assume there's a principal kind of structure that is set up. The parent has licensed all its intangibles to the principal, and the principal basically pays an arm's length royalty to the parent, and the principal uses a lot of toll manufacturers, contract manufacturers to produce the products, and then it sells in different markets outside the US. And let's just assume it sells in the Indian market on a remote basis. So under the current system, no PE in India, no taxation in India. Let's just assume in the German market, it sells through a limited risk distributor, and the limited risk distributor is booking an arm's length return of 2% on sales. And now let's just assume in the French market that this company, the principal, is selling through a full-fledged distributor, and this full-fledged distributor, after paying out royalties to the principal, which was on sub-license, is booking a profit of a return on sales of 10% post-royalty. So all these rules, they are according to the arm's length standard right now. So what happens after the Pillar 1 project comes into effect? Now, after the Pillar 1 project comes into effect, there would be an amount A allocation in India, because we assume that all the threshold tests are met, so there would be an amount A allocation in India, because that's where the sales actually take place. So there would be an amount A allocation in India. For Germany, what is relevant is amount A and B, because amount A will allocate the M&E group's global profits back to Germany based on the sales made in Germany. But amount B is also relevant here to fix the remuneration of the limited risk distributor, which could be a separate legal company. And probably amount B would here say, which is actually amount B stays within the transfer pricing system. And it's mostly, in my opinion, I think it's going to act like a safe harbor. And it will say that it will actually say that the limited risk distributors remuneration is going to be a return on sale of 2 or 3%. And if that kind of remuneration is booked by the limited risk distributor, so under the current international tax system, there will not be any more litigation with respect to the limited risk distributor. It's somehow something quite similar to the low value added services discussion that has already taken place. And if you look at Chapter 7 of the OECD transfer pricing guidelines, the markup that has been agreed on low value added services is cost plus 5%. But here for limited risk distributors, it probably will be 2 or 3% on sales. And if the multinational enterprise complies with it, then probably there will be no disputes. Interestingly, for the French entity, because you need to understand this, Pillar 1 project reallocates residual profits of the multinational enterprise back to the market countries. But what happens in the French market is that you have a full-fledged entity which is booking already quite a lot of substantial profits post royalties, and these substantial profits that are being booked in the French market could somehow have an overlap with the amount A allocation. So residual profits are already being booked, or entrepreneurial profits are being booked in the French market, and then amount A system also is going to reallocate something back to France. Well, in this kind of system, in this kind of example, there could be an overlap between amount A and the existing profit allocation rules. Now, how do you solve this overlap? And this is where a marketing and distribution safe harbor is being contemplated in the Pillar I project. And now, according to this marketing and distribution safe harbor, which will basically fix an amount, which will basically say something like, well, if in the French market under the current profit allocation system, you're booking 4% on sales, and if the full-fledged entities existing transfer pricing system show that it's booking actually 10% of sales, then the marketing and distribution safe harbor would actually kick in, and it will say that no amount A allocation will be made to France because under the current system, there's a lot of profit already being booked in France. But you can imagine a situation where you have the full-fledged entity, probably let's say it's loss-making, and then there's an amount A allocation. So under the current system, it is loss-making, but on the new system, there could be, on a group basis, it could be profitable, so there could be an allocation in France. And in this kind of situation, the amount A will need to be paid in France. So this is the kind of interaction that you see with the existing transfer pricing system with France as an example. An even more complicated and a challenging area is what happens if the French tax administration, they collect amount A in 1 year, but in another year, they make a tax audit on the French full-fledged distributor under the current international tax system, under the current transfer pricing system, and they basically increase the profits of the French distributor. So let's say in the year 2025, amount A has been paid in France, and at the same time in 2025, the French tax administration, they do a crazy tax audit and they boost up the profitability of the full-fledged distributor in France. In that kind of situation, once again, there's an overlap between transfer pricing, the profit allocation under transfer pricing rules, and the amount A system. So this is where the new binding dispute resolution process would kick in, or the dispute prevention mechanism of amount A would kick in order to ensure that the French are restricted from overtaxing the multinational enterprise in France. So there are a lot of complex interactions. Hopefully I was able to explain it in the limited time I have. So that's one issue with the transfer pricing, where transfer pricing rules interact with amount A. Another issue is which entity is going to be the surrender jurisdiction, which entity is going to provide relief from double taxation for the amount A liability paid in India, Germany, and France. Well, in our example, it's a bit more simple because it's the principal company in Switzerland which will have to do it, because this is the entity that has a direct sales connection with the Indian, German, and French market. But what happens if the principal company in Switzerland is actually a loss-making company itself? Well, in this kind of situation, the amount A credit bill will be passed on to the US because the Swiss entity will not have the profitability to pay the relevant profitability to bear the amount A tax bill. So the credit will have to be provided by the US parent in that kind of situation. So this is where we see this kind of tensions that come up with the existing transfer pricing and the amount A system. So back to you, Valentyn.
Many thanks, Vikram. Very interesting insights. Now let's talk about a US perspective. As you may know, more than 50% of multinationals that will be subject to amount A are headquartered in the United States. So it is of a great importance to see what will happen there, because eventually it will have an impact across many other jurisdictions. Amanda, based on where we stand today, what is the US outlook for Pillar I implementation? Thank you.
Sure, and apologies for the delay. I lost some of my buttons here, but I trust you can see my slide up on the screen.
Yes, we can.
Great, thank you. Yeah, so, as you said, many of the companies that are impacted by digital service taxes and would be impacted by Pillar I are U.S. multinationals. And countries aren't going to withdraw their digital service taxes if the U.S. Cannot agree to some alternative system. So the U.S. is an important player in whether Pillar I can be successful. So the United States at the Treasury Department has been devoting significant resources to the OECD efforts. It has worked to shape it from a prior iteration that it was more focused on the nature of the business, focused on digital and consumer-facing business as opposed to the current version that uses size and profitability thresholds. The Treasury Department has praised the agreements, obviously been very involved. Our Treasury Secretary has called the agreements a once in a lifetime or once in a generation accomplishment for economic diplomacy. Despite that, however, the implementation of Pillar I faces significant hurdles in the United States. Unlike Pillar II, which, as we'll talk about, has some elements that are actually already reflected in U.S. law, at least to some extent, and that law can be modified by legislation and our regular legislative process. I think the prevailing wisdom in the U.S. is that Pillar I would need to be implemented through a tax treaty rather than just legislation. And the processes are different for that, as I'll talk about. And the reason for why Pillar I would need to be implemented through changes to our treaties is that Pillar I would allow countries to tax foreign businesses, even if they don't have a physical presence necessarily in that country. And our current tax treaties with the approximately 50 to 60 countries require that there is a physical presence under the treaty permanent establishment rules. So the reason why the treaty process presents issues in the United States is that under our Constitution, treaties have to be ratified by the U.S. Senate and receive a supermajority, so 2/3 of our 100 senators. And getting 2/3 of U.S. senators to support potentially ceding U.S. taxing rights to other countries, which is how this is viewed by many legislators, will be a very significant challenge in the current political environment, where really even getting our U.S. Congress to agree on funding our own government is a difficult enough process. Another issue with Pillar I and the treaty route is that we have procedural rules in the U.S. that can effectively allow a single senator to block tax treaties from being considered by the entire Senate. That happened a few years ago where the U.S. Treasury had negotiated and signed numerous tax treaties, and a single senator held those up for about a decade. And then another issue is also that the likely path for Pillar I may be some sort of multilateral agreement, and in the tax space in the United States, the U.S. has not been fond of joining onto those over the years. Some have proposed alternative paths to implementation of Pillar I, including what people have called a congressional executive agreement that theoretically would require passages by both houses of our Congress, but would not require a supermajority, so could potentially remove some of the hurdles. However, that would present significant constitutional questions and would really upend many years of legal and process-related precedent in the United States. And then, of course, all of this raises major issues about the ultimate success of Pillar I if the United States doesn't implement it. And the question is, well, why would countries that have enacted DSTs get rid of those when the United States is not agreeing to give them rights to tax under Pillar I? Just one final thing that I'll note is that one might initially think that many of the largest U.S. companies would be opposed to Pillar I because they're of the potential targets of this and are subject to DSTs in many cases and would be subject to Pillar I in many cases. Many of them are actually urging the U.S. Congress to reach some solution. And the reason for that is because the alternative for them is multiple taxation, to have a completely uncoordinated regime where there's multiple DSTs in many different countries, and there's no real agreement on how income should be allocated to various countries. So it will be interesting in the U.S. to see whether some lawmakers can be convinced by those arguments as the OECD continues to work on more technical elements and moves towards trying to have countries implement Pillar I.
Thank you, Amanda. Very interesting, much appreciated. All right, now let's turn to Pillar II. As we already know, the global minimum tax essentially are domestic rules. Therefore, they will be implemented by way of changes to domestic law based on model legislation to be developed for this purpose. The Pillar II report has specifically emphasized that no changes to bilateral tax treaties will be required to put in place the rules. Of course, countries may join a multilateral convention, but only to facilitate the introduction of the rules in a legally binding and coordinated manner, as well as to confirm the compatibility of the new rules with the existing double tax treaties. So, based on where we stand today, it seems that double tax treaties will not pose obstacles to the application of minimum tax, global minimum tax. That said, Vikram, I know that you have deep dived into this topic, so could you please share with us your thoughts on whether Pillar II could indeed be implemented without changing double tax treaties?
Sorry, thank you, Valentyn, for that question. Sorry, I was on mute. And let me just give you a view on this question from the perspective from outside the US, because under the US system, you can actually override your treaties by following this later in time doctrine. Plus, in the US treaty policy space, the US has something known as a saving clause in its almost all of its tax treaties. So the conflicts with the US tax treaties are negated to a great extent. To the extent you can bring out some new arguments that the Article 9.1 should figure in the exception list of the saving clause, but that's a very technical thing. But in general, just to let you know that a lot of issues arise between tax treaties and these Pillar II rules. Now, if I just take the income inclusion rule and just let you know what has happened in the past. Now, before we get into the income inclusion rule, I'll just touch a bit on the CFC rules, which a lot of countries have. And these CFC, because the CFC rules are somehow, the income inclusion rule is somehow an extension of the CFC rule. Now, what has happened in the past is that in some countries, courts have actually held that CFC rules or deemed attribution rules like the CFC rules basically conflict with tax treaties. For example, some courts in Canada, in France, as well as in Brazil, have basically held that CFC rules conflict with tax treaties in essentially Article 7 of tax treaties, because the state of the parent is actually taxing the profits of the subsidiaries, where even though the subsidiary does not have a permanent establishment back in the state of the parent. So a lot of countries have already held there is an issue between Article 7 of tax treaties and existing CFC rules. But at the same time, a lot of countries around the world have basically, or courts from a lot of countries around the world have upheld that Article 7 does not, you cannot use the Article 7 to argue that a conflict arises, because every state is free to tax its own resident taxpayer the way it wishes to do so. But that is a typical Article 7 argument which is used, which is there in all tax treaties. But in the paper that we've written, we actually go beyond the Article 7 argument, and we try to explore new potential areas of frictions between tax treaties and these Pillar 2 rules. And one area of friction which we've identified is Article 9, because Article 9, traditionally has been thought of as only an article which deals with pricing, determining whether the price of a particular transaction among related parties is at arm's length or not. For example, whether the royalty rate, which is fixed at 3%, it is arm's length or not, whether the interest rate of 5% is at arm's length or not. But if you look into Article 9 and its historical development, you would come up, there are strong arguments which can be made that Article 9 can actually act as a limitation to income allocation rules, or deemed income allocation rules, or formulary rules. And the income inclusion rule, which is actually like a formula, because it reallocates profits, arm's length profits from one country to another country based on a formula, then it could potentially conflict with Article 9 of tax treaties. That is one area of conflict which we actually identified. Another area of conflict that we've identified is with Article 23. Just to let you know that a lot of countries, they have entered into tax-sparing clauses, and these tax-sparing clauses are found in Article 23. So for example, India, not only India, but a lot of developing countries, they have tax-sparing clauses with developed countries in the tax treaty network. And what this tax-sparing clause basically says is that if the taxes have been spared in a developing country with respect to a taxpayer's investment in the developing country, then the developed country should also not tax this kind of income. Otherwise, the effect of the tax sparing is taken away. So there are a lot of countries which have tax sparing clauses, and we are in a very special situation here, because the income inclusion rule tries to tax back the profits of an enterprise which the host country has spared from taxation. Just to give you a live example, so if we have, let's say, developed countries investor which has invested in a developing country, and it's operating through a permanent establishment in the developing country, and there is genuine business operations. Now, if the developing country is exempting the particular taxpayer from any taxes, from any local corporate income tax, because it has contributed substantially in the economy, then the treaty would typically say that the state of residence is supposed to provide relief from double taxation, or not tax it, or not tax the or not tax the profits which have been spared from taxation in the host country. But then now you have the income inclusion rule, and the income inclusion rule will tax back this profit of the developing country in the developed country, because it is not subject to any taxation in the developing country. So there's a tension between tax sparing clauses and the income inclusion rule. Already there was a tension with CFC rules and tax sparing clauses, but the same tension applies to income inclusion rule. So there could be a potential conflict. And the OECD in its 1998 report, they clearly said that there is a conflict. So the OECD in 1998 recognizes that there is a conflict between tax sparing clauses and CFC rules. So right now, based on that simple logic, income inclusion rules could also conflict with these tax sparing clauses of tax treaties. So this is with respect to the income inclusion rule. And then you have this undertaxed payment rule, which Amanda explained in a very well manner. There could be some tension between these undertaxed payment rules and Article 9 too, because Article 9 applies for transactions among related parties. The UTPR also applies, or the entire globe rules, they apply only for transactions among related parties. So one may argue that these UTPR rules will also come within the scope of Article 9, because they apply among related parties. And if they disallow deductions, even though the payments are at arm's length, then a conflict could arise with Article 9. And at the same time, what you all need to know is that the UTPR rules basically apply only in cross-border cases. And in many tax treaties, which countries have agreed with one another, there are non-discrimination clauses. And the non-discrimination clauses basically say that, a payment which is made by a domestic payer cross-border as well as domestically shall be treated the same. But here you have the UTPR, which only applies for cross-border payments. It does not apply to domestic payments. So there itself, you can see there's another area of potential conflict between income inclusion rule, between the UTPR rule and tax treaties. So at least in my opinion, a lot of countries, like countries which are more dualistic in nature, or where parliament can override tax treaties, at least in these jurisdictions, you can basically argue that, okay, there's no problem between the globe rules and tax treaties. But a lot of countries, including Switzerland, they are monistic countries. And here, international law clearly takes precedence over national law. And you cannot really change your national law subsequently to overcome your treaty obligations. So this is going to be a very interesting space, at least in my opinion. You cannot really apply these rules without changing existing tax treaties due to potential conflicts, but time will tell of what will happen. But I just want to let you know is that in the Pillar I space, the OECD has clearly said that, if a country wants to implement Pillar I in its national law, which they will have to do in the national law, they cannot just do it without changing tax treaties, because conflicts will arise between national law implementation of Pillar I, because formal reapportionment, and tax treaties which contain the arm's length principle, which is found in Article 7 and Article 9 of tax treaties. So in this new multilateral convention that is being contemplated to implement Pillar I, some superseding clauses are being proposed, which will regulate the conflict between domestic law implementation of Pillar I and tax treaties. So what we've proposed in the paper is that a similar approach needs to be followed for the globe rules. Otherwise, in the future, there could well be possible that the entire project tanks, because, if you don't change your tax treaties and you start applying these rules, then you'll have taxpayers going and filing claims before courts in different jurisdictions, and to see whether or not the courts will rule in their favor. So this is a very interesting area to actually witness and see what's going to happen in the future. So with that, back to you, Valentyn.
Many thanks, Vikram, for such original insights. The last question on the impacts and challenges on Pillar II is for you, Amanda. So as we know, one of the key parts of the political agreement on Pillar II is coexistence of the global minimum tax and the US minimum tax regime called GILTI, which stands for the Global Intangible Low-Taxed Income. As I understand, the GILTI regime imposes a minimum tax on certain foreign income of US multinationals, mainly excess of profits generated by US IP held offshore. And it is argued that both regimes have similar purposes and overlapping scopes, and it seems that their design is still different. So it is not clear if the US GILTI regime would comply with Pillar II minimum standards to be considered as a qualified regime. And this problem is still remains unresolved as of today, and based on overall importance, political importance for the global tax deal of this issue, Amanda, based on where we stand today, could you please share with us what is how this regime, GILTI regime, is related to Pillar II, how it operates, and whether it needs to be modified? Thank you.
Sure, I would be happy to address that question, which, as you said, raises some very interesting issues. And in fact, as I'll talk about, some of the issues arise not only with our GILTI regime, but also with another relatively recent regime enacted in the US called the Base Erosion Anti-Abuse Tax, or the BEAT. So as we'll talk about, the GILTI regime can essentially be viewed as a global minimum tax imposed on a US multinational's foreign income. And then the BEAT, on the other hand, is its own form of minimum tax, but on U.S. corporate earnings, with the minimum tax being imposed on a modified tax base that is calculated without regard to certain deductible and other related party payments made to foreign persons. So the OECD has said that the inclusive framework at the OECD recognizes that an agreement on whether the U.S. GILTI system can coexist with the globe is needed. And the OECD has also encouraged the U.S. To limit how the BEAT rules apply in respect of payments to entities that are subject to a high enough rate of foreign tax, which we'll talk about. So I'll go through at a very, very high level how the GILTI and BEAT regimes operate to provide some background for how they might interact with Pillar II. So what the GILTI regime basically does is tax U.S. shareholders of what we call controlled foreign corporations, or CFCs, with respect to the earnings of those CFCs. So again, at a very high level, what it does is essentially tax a U.S. shareholder on its share of a CFC's active income. And I say active because we have a separate set of CFC rules that apply to passive type income. So the U.S. shareholder is taxed on its share of this CFC's active income, but generally at a lower rate than U.S. corporate income would be, or in fact even the other CFC passive income. So U.S. corporate income tax rate is 21%, and the GILTI rate is generally 10.5%, with the lower rate actually being affected through a deduction mechanism. And on GILTI, a U.S. shareholder can also claim a foreign tax credit for foreign taxes that are paid abroad, but it's limited to 80% of the foreign taxes. So some people might describe GILTI as its own minimum tax on foreign earnings, because what it essentially does is it subjects foreign earnings to U.S. tax if they aren't subject to a 13.125% foreign tax rate, as 80% of 13.125 gets you to the 10.5% rate that's imposed. So in practice, the GILTI regime can kick in even where there's a foreign tax rate above 13.125% because of the way certain of our rules interact, but that's what the basic theory is behind GILTI. And note that also GILTI is taxed on a global blending basis. So if you have losses in one controlled foreign corporation and income in another, those can be netted against each other. And that's different from GLOBE, which is or the income inclusion rule in GLOBE, which would be implemented on a jurisdiction by jurisdiction basis. So the second area of potential conflict is the BEAT regime, which applies to U.S. corporations, regardless of whether they're U.S. or non-U.S. parented. And this slide has the formulation, but really what you need to know is that the BEAT requires a large corporation to calculate an alternative tax base and then apply a rate to that, which is currently 10%. And the alternative tax base basically starts with taxable income, but then adding back certain payments that are made to related foreign persons that are considered base eroding under the legislation. So a very basic example of that would be a payment that's deductible for U.S. tax purposes that's made to a foreign related person. So with that background, as I mentioned earlier, both of these regimes have raised concern. With respect to guilty, there's a question about whether it can be considered a qualifying income inclusion regime under Pillar II under the globe, given that it has some key differences from the income inclusion rule, including, as I mentioned, that guilty is calculated on a global blending basis rather than a country-by-country basis. The guilty rate is lower than 15%, and that the guilty regime also has a substance carve-out that is also slightly different from the globe, and that guilty only looks to 10% of tangible asset basis and not payroll. There's also questions about how guilty would interact with an income inclusion regime in what's called a sandwich structure, so where there's a non-U.S. parent on top that owns a U.S. company that in turn has foreign subsidiaries. There's a question about how the U.S. regime would interact if that foreign parent has enacted its own income inclusion rule. Right now, the OECD is continuing to say further consideration will be given to these issues. And one major question, which I'll address on the next slide, is whether the U.S. might make changes to the guilty system to make it more in line with the OECD proposal. With respect to the BEAT, there are also some pretty major differences. From the undertaxed payment rule and other aspects of Pillar II, one of which is that the BEAT applies to payments without regard to whether they're subject to a sufficient rate of foreign tax. And one thing, going back to the last question, that I would also note, as Vikram was talking about the undertaxed payment rules and issues with conflicts with tax treaties, and one of the potential conflicts being the non-discrimination issue. That has been an issue that has also been raised in the U.S. context with respect to the BEAT. But as Vikram also mentioned, under U.S. law, it's possible for Congress to override a treaty through the later in time rule if the statute is a later in time enactment. But just to note that in the U.S. That has been a very live issue as well in an analogous context in recent years. So with respect to the legislation that's pending in Congress right now and that potentially could be enacted in the next few months, as I mentioned, there are some aspects of it that would move the U.S. regime to be more in line with aspects of Pillar II. So with respect to guilty, the legislation would increase the effective rate on guilty, moving it to be approximately 15% to be more in line with the income inclusion rule. Instead of the current blending approach, guilty would also be calculated on a country-by-country basis, so also more in line with what the OECD has proposed. So in those ways, the guilty would be moved more in line with the income inclusion rule, but there would also continue to be some differences where guilty would not be consistent with the income inclusion rule, in particular with respect to not allowing a return on payroll. For the BEAT, the pending legislation would also modify several aspects of the BEAT, including, importantly, providing an exception from the BEAT for high taxed payments. So where a payment might otherwise be added back to income under the BEAT because it's a deductible foreign related party payment, the legislation would essentially not have that payment be subject to the negative consequences if it's taxed in a foreign jurisdiction at a sufficiently high rate. So clearly one question on all of this is whether this legislation will be passed, and then whether it's sufficient to address the OECD's concerns about the potential conflicts between the regimes. And then if the US legislation is not passed, then we'll continue to have the question about whether the OECD will view guilty as an acceptable regime, and similar enough to the proposed income inclusion rule, and whether the OECD can also find a way to live with the BEAT in its current form. So with that, I will hand it back.
Many thanks, Amanda. Very interesting indeed. We are a bit short on time, so now let's move to our final part and talk about regional perspectives. Amanda and Vikram, could you please share with us your observations on the next steps and the process in the European Union and the United States? And this time we'll start with you, Amanda. Thanks.
Great. Thank you. So I've addressed a lot of the issues with respect to the view from the United States, but perhaps I'll start here with the OECD's target process, and then Vikram can add his insight to this. So this table up here has the target process for the OECD efforts. So on one hand, we have the target dates for Pillar I, which is to, at the beginning of 2022, have the text of a multilateral convention and an explanatory statement to implement Amount A, and then also to have model rules for domestic legislation that would be necessary for the implementation of Pillar I. And then later on in 2022 to finalize the work for Amount B. And then with respect to Pillar II, the target date for both model rules to further define the globe rules and model treaty provisions for the subject to tax rules was November 2021. As we know by our calendars, that date has already been passed and we have not yet seen those rules. The OECD has said that they will be out soon and that the rules will be followed later by commentary to explain kind of the drier, more technical rules. And then after that, the OECD in 2022 is targeting a multilateral instrument for implementation of the subject to tax rule in tax treaties, and then at the end of 2022 to have an implementation framework to facilitate coordination of implementation. And so the target for both Pillar I and Pillar II is that these regimes could be implemented and then I think become effective later in closer to 2023. I would, just to close out, I would describe from my own point of view, I would describe this as a very ambitious timeline. I think that's probably the polite word. I think one can argue that the timeline really has to be ambitious given the global situations with DSTs. As Vikram mentioned earlier, there's the many tax issues we've talked about, but there's also significant trade issues. The US has previously threatened several countries with punitive tariffs after they introduced their DSTs. After the OECD agreement was reached, the US did have an agreement with some of the countries that have DSTs, which is that the US would not impose the tariffs, but the countries did not agree to get rid of their DSTs unless and until Pillar I is implemented. So that will continue to be an issue in the United States. And then, of course, as I mentioned, we will continue to have the issues with respect to what the U.S. Congress will do and whether Pillar I can really be implemented in the United States. So with that, I will pass it back to Vikram for comments.
Well, I will not use slides anymore, but just to know on the pillar, let me just start with pillar 2, because I think the pillar 2 project has somehow, there was like this, since childhood we've been hearing the story of the tortoise and the hare, and initially you had the hare being pillar 1 and the tortoise was pillar 2, but now it's reversed. It's the pillar 2 project which is gaining more momentum around the world as compared to pillar 1. So let me start with pillar 2, because even if you think about it, all the politicians, they actually speak only about the global minimum tax.
So I guess we'll give Vikram a couple of seconds to connect, and in the meantime I probably can give a brief outline of a Mexican perspective. Mexico was among the first to back up the global tax deal, and it is expected to collect around 1.5 billion US dollars in additional tax revenues. Speaking of Pillar 1, last year Mexico enacted digital services taxes. Although no further technical explanation of Pillar 1 has been released so far, these Mexican digital taxes seem not to be of the type of taxes that are expected to be repealed under Pillar 1, since the target of these taxes is Mexican consumers of digital services, but not the service providers. So the main objective of adopting the digital taxes was not to regulate technical or legal aspects of the digital economy, but rather to facilitate the collection of income tax and VAT from Mexican customers by means of shifting the burden to the service providers, which actually may not have even physical presence in Mexico. And with respect to Pillar 2, Mexico is a capital importing country with 30% corporate income tax rate. An average effective tax rate is also close to 30%. Since, well, of course, companies or taxpayers could lower this effective tax rate, but they'll have to be engaged in certain types of specific activities provided in the law. Since recently, the Mexican tax administration has started publishing also effective tax rates across different industries to inform taxpayers about potential tax audits if they find themselves outside the range of these numbers. However, these effective, and I would say that they're very low, this effective tax rate should not be considered or taken as a reference for purposes of Pillar 2, because they are calculating differently as a ratio of income tax expenses to revenue as opposed to profits based on the Pillar 2. So for Mexico, the global minimum tax would mean basically a top-up tax on Mexican and non-Mexican multinationals with respect to their low-taxed foreign subsidiaries, as the case might be. Another point that Mexico also qualifies as a developing country, so the subject to tax rule is expected to apply. However, its applicability in Mexico will be limited because first, the rule will apply only to payments made to jurisdictions that have double tax treaties in place with Mexico. And second, the targeted payments such as royalties and interest made to related parties, in most of the cases, they will not be subject to taxation below 9%. So, of course, that said, still there is no clarity which other types of payments eventually will fall within the rule. And if we're talking about service payments, in this case, it could be game changer with respect to subject to tax rule in case of Mexico. Vikram, are you with us?
Yes, I'm sorry, I just dropped out. My Wi-Fi just switched off. I think my son was playing with the computer and he pulled out the Wi-Fi cable, so I had to just run and put it back in. Sorry for that. I guess
Don't worry,
this is a problem from working from home, but
don't
it's
worry, it's
okay.
okay.
Yeah. No,
It's
so
okay.
I just wanted to say for Pillar 2, basically, it's really ambitious to ensure that these rules are implemented in 2023. So like Amanda mentioned, the model rules will probably come out before Christmas. So they're going to be a Christmas reading. And then we have, so we are occupied for Christmas, not only with the family, but with the OECD too. So after Christmas or before Christmas, let's say the European Commission is also going to come out with a directive on implementing Pillar 2. And this just to tell you a bit about directives within the EU, they usually take 3 to 5 years before implementation. And if you think about the European Anti-Tax Avoidance Directive, which was published as a result of the BEPS plan, it came out in 2016. Then national transposition in some countries is still taking place. It's not yet done within the EU bloc. So it takes time to change, implement the directive in national law. So 2023 looks really ambitious, and even from a Swiss standpoint, it just seems impossible to implement the income inclusion rule in the Swiss national tax system in 2023 because Switzerland historically they've been following this system where they, profits attributable to foreign establishments is exempt, or dividends coming from outside Switzerland into Switzerland of big multinationals, they're exempt under a participation reduction regime. So just changing all these rules by 2023 is, I think in the Swiss system, it's not possible at all because the legislative timeline is quite high in Switzerland. So 2023 for Pillar 2 is really wishful thinking. Probably 2025 or 2024 would be more realistic, I would say. That's on Pillar 2. On Pillar 1, one of the big questions is whether European Union will issue a directive or not on Pillar 1. Because, at the end of the day, if all the European countries are joining the OECD Pillar 1 multilateral convention, then what is the use of an EU directive? It doesn't make any sense because all the OECD countries will have to, which are also the European countries, will have to implement it in their national law as well as be a part of the multilateral convention. Now, initially, the Commission did mention there will be a directive on Pillar 1, but I guess now they are really rethinking whether it makes sense or not to have it. It could make some sense when they have some Pillar 1 has some disputes under the current framework. Amount has some kind of interaction with transfer pricing disputes under the current framework. So possibly to regulate these dispute, the relation between the EU Dispute Resolution Directive and the Amount A system, this is something which can be in the Pillar 1 directive, but the substantive rules are basically what the OECD is introducing. So it doesn't really make sense to just replicate that in the EU system. But once again, it's wishful thinking it's good all the countries will sign the multilateral convention, but national implementation of this will take, it's challenging in 2023. Let's put it across like that. So probably it has to be extended. And we are already seeing this. For example, in 2013, they started the BEPS project. In 2015, they delivered the the Action 1 report. And now we are in 2022. We are talking almost in 2022, 6 years later, we are still talking about digital taxation. So, at least give the country some time of 4 or 5 years to implement these rules. Otherwise, it's going to take some time. So I will stop here.
Many thanks, Vikram. We are almost out of time. Actually, we are out of time. So let's quickly move on the Q&A session. We have several questions that have been submitted by the audience, but unfortunately we have just time for one question from Yvonne. And I guess it's for you, Vikram. So the question is whether binding dispute resolution would mean that multinational subject to Pillar 1 will have their transfer pricing free from further inquiries or not?
No, that's not the idea here. So I think litigation will keep continuing under the transfer pricing system. But let me explain what the idea here is. So if you just take a big multinational like Procter & Gamble, and two situations. One situation, Procter & Gamble has a subsidiary in Switzerland, and another example is Procter & Gamble has a subsidiary, let's say, in India. Okay, it's a US-based multinational. So in this example, if there's a transfer pricing dispute in Switzerland, then this transfer pricing dispute can actually be solved through the mutual agreement procedure which is there in Article 25 of the OECD model. Plus, there is access to arbitration in Switzerland. So the Swiss-US treaty, I believe, has an arbitration clause, and then you can have access to arbitration. So the dispute is finally settled at some point in time. But if you just take a similar example with India, India-US treaty does not really have arbitration. So even if you invoke a map and there's no agreement in a map, then what does the taxpayer do? The taxpayer, because according to the map, the competent authorities shall strive to come to an agreement, but if they don't come to an agreement, what does the taxpayer do? And for this kind of situations, there is beyond amount A tax certainty that has been highlighted in the blueprint. And it is this kind of situations where they will say that there is going to be a binding mechanism to ensure that the dispute in India is resolved. And because the profit allocation under the existing system has some links with the amount A system, then if there's some kind of surety under the existing system, then you can clearly determine how much amount A will be allocated to India. So that's the idea here. The binding mechanism will somehow bind India to provide or come to an agreement with the US on how profits will be allocated in India.
Many thanks, Vikram. I'm afraid we are out of time for more questions. We'll do our best to answer the remaining questions offline. And this brings us to the end of the webinar. I would like to thank to Inteli-Iuris for space, and of course to our experts, Vikram and Amanda, for sharing your very valuable insights and expertise. Thanks everyone who joined us today. I hope you found the webinar useful, and have a wonderful weekend. Goodbye.
Thank you. It was a pleasure. Thank you, Amanda. Thank you, Valentyn, Luis, and all the participants who joined in. A pleasure to be with all of you.
Thank you. Bye-bye.